Everyone, Douglas here, Canon Market Analysis. It is Saturday, April 20th, 2019, 7:53 p.m. Eastern Standard Time. And earlier this week, I increased my my long dollar position. It's actually a short Euro ETF that I play. And in the little blurb that I had for the portfolio update post, in that little blurb, I pretty much discussed a few things. One, that the data from the European side is looking worse and worse. Two, that it does seem like an inevitability that sooner or later we will kind of have another global downturn, a global kind of recession cycle. As it stands on the kind of U.S. side of things, I think we're still 6 to 9 months out, maybe inching slightly closer, but still we are some distance out there. And I could even see a scenario, a pathway of that even extending further, 12 months, 18 months, even longer, but that's down the road and not really what I want to talk about tonight. But I do think that the downturn will kick off, likely in the European sector, possibly in the emerging market landscape as well. And so I want to take a look at really what I think is happening there and why I think a long dollar the long dollar case is such a strong case, and why I want to add that to kind of the overall portfolio that I'm making up. And I do see it as a bit of a hedge play as well. We'll look at the Eurozone ETF, because a logical question is, well, if you think Europe is going to be so bad, why not just play the Eurozone ETF? Well, I still think we could see kind of a dislodgement of the correlations there, and I could see equities kick up, and I don't see too much downside risk to the dollar index right now. And so that's kind of why I wanted to go with the dollar index. And if it were to turn lower, I still think we would see some acceleration in U.S. equities. So again, it would be a nice hedge. And this is just kind of my strategic trading, if you will, positioning. I've noticed as I kind of analyze, and do this from time to time, I analyze my prior trading. I notice my poorest performing time frames are usually kind of right before big turnarounds, because I tend to get a little aggressive, and then I'm just not positioned the best, and I kind of get spooked. And I just end up making some bad decisions during those kind of transition phases. So what I'm really looking to do is prepare myself leading up to that turn to be positioned the best, where I don't have to make super aggressive moves, and that I can let things just kind of play out until I can see some good confirmation to want to get on the short side. So just kind of give you my overall thought. Again, just to be clear, I still think in terms of kind of major recession downturn, we are still at least 6 to 9 months out, if not further. But I am starting to see things deteriorate on the European side of things, and that's kind of what I think will also precipitate the takeoff in the dollar. All right, so let's get rolling, and I'm going to kick things off taking a look at the dollar index. And here's what I want to do. I want to look at first kind of the dollar index chart, which this is really what precipitated the trade. I really like the pattern that I'm seeing, and then we'll kind of go into some more macro discussion in terms of kind of the underlying scenario that I think is going to drive the dollar higher. But all in all, it really was the dollar index chart that made me say, you know what, I think we could see a breakout here soon. It's looking bullish, and so I want to lay out exactly the case that I think will happen over the next couple of years, and then more immediately kind of what made me want to go ahead and execute this trade. So long term, in terms of the dollar, I think from that 2008 low that we had in the dollar index, I think we're in a long-term WXYZ, so these would be primary WXY for a larger cycle here in the dollar index. And as it stands right now, and this could definitely change further down, we'll see kind of how the wave structure develops further down. But I do think 130 would be a reasonable target here on the dollar index. I know it's very high, and that'd definitely be contra much of kind of common sense or kind of common takes on the dollar index. But I think as I do this update, I think you understand why the vast majority of people are quite wrong on the dollar index. Diving in a little deeper, we do have an A, B, C for a flat for the W wave in and of itself, three-wave pattern for A, three-wave pattern for B, and then a five-wave pattern for C. And then a flat pattern or a flat pattern for the X wave for the connector. And finally, I think we're in the kind of early to mid stages, possibly about to break out stage of the X wave, or I'm sorry, of the A wave here, of an ABC. We would then expect an ABC pattern to play out for the Y wave. So so that's kind of the longer term picture. Moving into the daily chart, let's see. I do think we will get good confirmation for a couple of reasons once we get above right about 98. There is right at 97.75. You have a kind of a triple top there, if you will, of resistance. But more importantly, right at about 98, that will get us above the 61.8% retrace of that entire move down from January 2017 into the early 2018 lows. So a break above that 61.8%, that would be very important just in terms of kind of invalidating any idea or really diminishing the possibility of an idea that this could be some counter trend to the initial move down during 2017, and definitely adds to the probability that this is going to be a breakout. I like the turn up. I like everything I'm seeing technically speaking. I don't have it pulled up, but the euro itself looks like it wants to completely collapse. And just from a technical level, it looks like we might be seeing the kind of finally the turn up that we're looking for, and kind of that burst higher that I think eventually will happen. Very similar to what occurred in 2014 through 2015. And take us into this first leg higher. This first leg then being really the big leg that's going to put a ton of pressure, the big burst up that's going to put a ton of pressure on the globe and likely cause the eventual recession to hit the U.S. as the globe slows down entirely. So that's what I'm seeing in terms of the dollar index. Moving on to the Eurozone ETF as well, and I've showed this many times, but it's just worth noting that long term, after the 2007-2008 sell-off into 2009 from the Eurozone, we clearly have not in any way, shape, or form made any sort of impulsive move. This has been a counter-trend move, and in the grand scheme of things, we are really seeing a long-term kind of bearish move that really started off in 2007. We'll see this in some of the data that we look at as well, that will likely conclude soon into some more selling into a C wave, and the end result in this, I think, will likely be the end of kind of maybe it could get as bad as the end of the Euro block, the Eurozone altogether, but quite likely a replacement of some sort of replacement of the euro itself, is that system is unsustainable, and just growth cannot happen in that system long term. So again, I've mentioned this before. I think there is one possibility where you could get one slightly higher high and then a rollover in equities, and that's why I'm a little hesitant to want to go ahead and short the EZU here. I do think we're about to hit some major resistance right at 42. That'll be an important spot when we do get there. There's kind of a lot of support at that zone, or was support and then became resistance. So that could be a resistance. If we do break through that, then maybe one more high makes sense, and that could coincide with a blow off top. But it doesn't have to with a blow off top in the U.S., but we don't have to see the U.S. and Europe move in lockstep, and we didn't during the majority of 2018. Made new highs in the U.S. and never came close in Europe on most of the indices. So but with that being said, I think there's a far greater risk that we see kind of a blow off top in European shares to coincide with the U.S. Than there is any sort of move back down in the dollar index. And it's worth stating too, there is still the possibility that we could move down, and you'll see kind of why that's the case. But from the dollar index, I still think we're going to shoot up, and eventually that will lead to a rollover in European equities. And I think the rollover in European equities could come sooner than later, and this will definitely be a short situation that I'd like to jump on when the moment kind of presents itself fully and we get good confirmation. So yeah, things still looking pretty poor in Europe, and I'm definitely not expecting any big move up in Europe as well. So anyway, just wanted to start off with the charts, kind of get that in mind. And now let's go to some data points that have rolled out recently. And let's start with the French manufacturing PMI. Really disappointing. Not only did it disappoint in terms of or kind of continue lower, although mildly lower, still lower. It missed the consensus by quite a lot as well. Under 50, that's kind of the recession zone, if you will. That is contraction, so not looking good for France. The Eurozone as a whole, which is effectively, this pretty much mirrors the German manufacturing PMI as well below 50. Even though it did increase, the expectation was for a much higher increase, and just not seeing it. So a lot of contraction still happening in Europe, and just poor conditions across the board. So seeing those readings, seeing them disappoint, that definitely adds to the argument that we're seeing some big issues happen in Europe, and in reality too. Everything that we're seeing with regards to kind of the European deterioration and kind of this entire event that I think is still ongoing, really began at the beginning of 2018 during that sell-off, or at the beginning of 2018, and has really just been one long event that I think is going to culminate in kind of multiple instances of pain in the European zone. So there's that, again, just kind of adding to kind of more of an argument why I think we're going to continue to see pressure on the European side, and that pressure will ultimately lead towards dollar strength. And the reason for that, which we're going to get to now, is because of this thing called the Eurodollar. And the Eurodollar, a Eurodollar is, as opposed to the Eurodollar system, which we'll talk about in more detail, a Eurodollar is nothing more than a dollar, a US dollar, that is on deposit in an international bank. And that's, you can look this Wikipedia article up and get a definition, a little bit better understanding, but that's effectively what a Eurodollar is. And what ends up happening is the international banking system uses that money, those dollars that go on deposit, to effectively fund trade. And they become effectively, it's far more diverse and far more complex than this, but they effectively use those as reserves, as a backstop, the physical dollars, if you will, or the literal dollars, to create Eurodollars, which are kind of loans that are backed by those dollars that are on deposit. And this is how the entirety of the international banking system works. Since so much of the banking system internationally uses the dollar as a reserve, you have, oil is dollar reserves, debt is denominated in dollars, so much trade is settled in dollars. Obviously, the US dollar is very important, so therefore creating a money system around dollar deposits internationally is quite advantageous for international banking, and it was right up until what we're going to see until 2008 brought the entire system crashing down. So the big takeaway here about what the Eurodollar is and what the Eurodollar system is it's dollars that are on deposit. So someone, for whatever reason, has dollars, whether it's they sold oil, it's a Saudi king selling oil, or you sold goods to the US and you put those in a dollar denominated checking account. That is what a Eurodollar is. Then the Eurodollar system itself is what is going to create the necessary credit expansion for the international market that needs dollars, and uses those as the backstop for that entire kind of liquidity system, if you will. So that's what a Eurodollar is, and what the Eurodollar system is. Now, the next thing I want to look at is the TIC data, and that can be found, if you're interested, on the Treasury's website, and it's the historical data right here that you want. And what we're going to look at is the claims on all foreign residents by type and counterparty. Essentially, what this is the growth of the Eurodollar as denominated by dollar claims within that system. So let me bring up this chart right here. 1 second to turn this on. And this is the actual TIC data. So you can see, starting in the 90s, I should say starting in the late 90s, you saw a massive increase of the dollar deposit system growing, the Eurodollar system really taking off to fuel international growth. And in 2007, 2008, the entire system broke down, and it really has been deteriorating ever since. Okay, now, effectively, again, what this is this is the dollar-denominated debt growth throughout the world. This is the growth of the Eurodollar system, and at the heart of it is the dollar-denominated debt. And what we can end up getting from this is, and I'm going to zoom on in now to the TIC data versus the dollar index. And what we see, and this makes a lot of sense because of the functionality of how the international banking system works, is we see a very strong inverse correlation between the TIC data and the dollar index. And I've gone ahead and inverted the TIC data here, and you can see the correlation is quite strong between the TIC data and the dollar index. Now, if you can see this, on the TIC data, which is in blue here, is ticking up. So you would expect then the dollar index to be pushing down. The unfortunate thing is this data is quite delayed in terms of what we can get hold of. It's about a 2-month delay, and it's pretty much the most real-time data that we can get in the entire space of this entire Eurozone area. And that's why we really have to rely on kind of the charts, the dollar index itself, to really time things. The other thing too that I've noticed just in general on this chart is we oftentimes see big bursts up in the TIC data right before big swings. So I do think we're likely hitting kind of the upper boundary, that last kind of expansion, before we see the next cycle down. So yeah, pretty much the good thing about this is it does kind of prove the theory. The theory is that there is a correlation between kind of expansion and contraction with the TIC data and the dollar index, and we would expect to see a correlation there. It shows up, so it kind of confirms what it is that we think should be happening, and so that's good. So we do know that it is the banking system, that the European banking system, that is the problem. I should say the Eurodollar funding system that is the problem, that is really taken over and driving driving really the price of the dollar index more than anything else. There are other drivers, obviously, but more than anything else, it's this system. So what ends up happening then, to kind of bring this picture all together, what ends up happening in terms of the banking system is, as things like oil increase, as costs increase, as just the general business cycle churns on, the debt becomes more and more difficult to service, right? Expenses rise, the debt becomes more and more difficult to be serviced, and this banking system locks up. And that's exactly what we saw in 2007, 2008. It is a very shallow understanding of the great financial crisis to call it a housing market crisis. It really was a complete failure of the Eurodollar system. So what happens then is, to kind of give an example, right? Just imagine if you yourself, you were in a bunch of debt. You had a mortgage, you had a credit card, you had a car payment, and you obviously have your income. You have a job, you work in 8 to 5, and you get laid off, or you for whatever reason, in this system, as it turns out, you just leveraged yourself way too much, and you thought the income was going to continue on. So that might be a good example. You thought you were going to get that big raise at the end of the year, you never got it, and eventually you hit this point where you just can't make all your bills. You can't pay all your bills, and the creditor is knocking on the door, and they say, "Hey, you owe." So what do? You fire sale, right? You sell any assets you have to make sure you can make those payments, so you don't default and go into bankruptcy. And have a judge, determine what assets. And that's what ends up happening when this system kind of reaches its apex, is you end up getting the fire sales. And that's exactly why we saw equities sell like they did in 2008. That's exactly why Europe continues to see 30% drawdowns every couple years. Because it's those fire sales. They have to get rid of the assets on the book to raise dollar cash. A lot of assets that are denominated, obviously you sell all your dollar denominated assets. So that's your oil, that's any equity shares, that's bonds, that sort of thing. So you can, or treasuries, so you can get the dollars themselves to pay off the dollars within the system. Now, obviously, as those assets are crashing, those are also assets on the bank's books, and you kind of get a run on the bank, and the banks don't actually have dollars. They have these Eurodollars, right? And those Eurodollars work until they don't. And we can tell when this pressure starts to amount, because we can see a break in the interest rate of LIBOR, which is the Eurodollar interest rate, and the interest rate of treasuries. And this is where I want to take you to next. So hopefully you get that example of you have too much debt to service, and you thought you were going to get that raise, but you didn't, and now you are in a position where you have to sell assets in order to service the debt and to come up with dollars. And to make matters worse in this scenario, and make it a little bit closer to reality, in this scenario, when you go to sell those assets, the people you're selling them to don't actually have real dollars in the bank. They're just Eurodollars. They are kind of derivatives of dollars, and there's no real dollars backing them. And so you could imagine then that bank has to sell its assets, and then it goes on and on. And the whole system kind of comes to a stop. So like I was then getting at, you can see when this pressure starts to kick up, because the interest rate, the overnight interest rates on the LIBOR on the Eurodollar transactions begins to, the spread between that and the Treasury begins to get higher and higher, because the Treasury can obviously always, Treasury is the Federal Reserve, can always accommodate any demand for dollars. They have the Treasury as a backstop, so they can do that. But international banks don't. They have to sell assets to get that. And so that means that Treasuries are always safe. Eurodollars are not. So what we can do then is look at that spread and see if, let me turn this off and go back to this. What we can do is we can see then, what I'm looking at is what's called the TED spread, and the TED spread is calculated between the 3-month LIBOR and the US dollar 3-month Treasury bill. And so this is a spread between the interest rates, and you can see going into 2007 we had a huge blowout between the rates, and then eventually we calmed down, and for the most part have been calm, with the occasional flare up happening every couple years in the TED spread. Now recently, very recently, if we zoom in, we've been hitting very much the lower boundary that we've seen over the past few years before we finally take off. So I do think we're at kind of that very low point in the valley here of the cycle, and we're just starting to tick up. Unfortunately, again, we're at a delay to get this data. It's a 7-day delay. This is also, I've oftentimes talked about the LIBOR OIS. The LIBOR OIS is an even closer spread. That is the overnight spread, and oftentimes can be the first indication when that takes off. So I will look at Twitter from time to time and see if anyone's posting that. Some banks that have the tens of thousands of dollars a year to get that data we'll post it on Twitter. So that's always a good idea to search if you're interested real time, if things are looking kind of funky in the markets. See if LIBOR OIS is kicking off, and I'll always mention that when I see it. But that's another good indicator as well, in terms of if that international banking is starting to crunch up. And yeah, like I said, I think we're getting close to the end of the cycle, and we're going to start seeing it turn up, particularly because of just the continued bad data that we're seeing in Europe. And I do expect some tight conditions in international lending going forward. So yeah, that is kind of the TIC data. That is how we can also see and kind of get a full understanding of what's happening in the Eurodollar market, and then the TED spread here, how that kind of mixes together with this as well. All things just seem to be at that point where they oftentimes turn here, and likely going to be kicking up here, at least with the TED spread and the spread. So yeah, I hope that made sense. That was a lot to cover. All right, so just to kind of summarize one more time before we move on to the U.S. data and kind of what we're seeing there. Again, there is, and there has been really since the late 90s through the 2000s, a massive expansion of international banking and the growth of the Eurodollar system as the main liquidity mechanism, and that has wreaked absolute havoc. It was a good system when it was created. It was a better system than they had back in the 60s, 70s. That's when this thing really got taken off. Just the amount that it's grown has not been a good thing. And then you pair that with, too, on top of that, you pair that with the massive increase in the banking sector as a whole, total banking assets as a whole, of GDP for Europe relative to the rest of the world. It just dwarfs the rest of the world. And that creates that dynamic that is so unstable. And like I've said, I've talked about this quite a few times. I mean, that's why there have been 1, 2, 3, since 2008, 4 times there's been a greater than 30% drawdown in European equities. And we're in the midst of still in the midst of another one here. And why Europe has been so unstable. And then on top of that, from a sectoral balances standpoint, we continue to see a decline in government deficits, meaning that the financial sector, this has to continue to grow if you want to see an economy grow. And what we're seeing is very similar to 2008, where we're seeing a contraction on both sides of of government spending and of the financial spending. So we're just seeing contraction of the economy again on both sides of the sectoral balances. The kind of the one thing that has been keeping the European economy afloat has been the rising current account surplus. But that is starting to deteriorate, meaning they have been bringing in the necessary financial assets to keep their economy afloat because of their exports. That's been taking a hit. We see that particularly in the data that we look at, the manufacturing PMI. Obviously, if that's dipping, that means likely that they're having some issues with their exports. And so that feeds into kind of the issues that they're having. So from a macro perspective, it just looks pretty bad. And what will happen when this finally implodes is we'll see a huge takeoff in the dollar index. And I think my suspicion here, just to kind of wrap this up, my suspicion is, to go back to the dollar index here, is we will see a big rip higher in the dollar index. And I meant to say this earlier. Let me put it in this perspective. If cash is really just the opposite side of debt, right? And if you are long anything, if you're long growth, by definition, you're short cash. And what I mean by that is if you're long assets, right? If you're growing your financial sector, hoping that those assets grow in value, especially if you're doing it through debt expansion, by definition, you're short the opposite of cash. So if you go buy a home on a mortgage, right, you are short the dollar. If you're doing this in dollars, you're short the dollar because you effectively have that loan. And if the dollar were to increase and your house were to decrease in value, you're essentially losing money on that, and that debt becomes worse to pay than it did prior. However, if the value of the dollar goes down and the value of your home appreciates, then you're obviously making out on that trade, if you will. And so when the economy expands through debt expansion, which is what the Eurodollar system is, through debt expansion, it's short money. And when it goes the opposite direction, or it's short cash, short US dollar, when it goes the opposite direction, it's a short squeeze. And I think that's exactly what we're seeing. It's a very slow short squeeze get played out here. And what I think the end game of this is going to be is really this will cause the end to, and this is down the road, this is much past 2020, probably closer to 2023 to 2025, but not only will this cause an end to the euro as a currency, but it will also cause an end to the dollar as the reserve currency of the world. Many nations are waking up not only to kind of the US's abuse of this. Trump has become a master at abusing this to our advantage, but just the reality is that there's just not enough dollars to go around. And no economy wants to keep going through crisis every 5 years. So, and I think more and more central bankers, especially central bankers outside of the U.S., unfortunately, the U.S. is completely blind to this reality, but more and more central bankers are starting to pick up like, hey, it would be of our benefit to not use the dollar as the reserve currency and get away from so much trade and debt denominated in dollars, so they could create the necessary liquidity in their own environments and in their own trading blocks, and not kind of be at the whim of what's happening at the dollar. So before that happens, though, the pain needs to get so bad, obviously, and I think that is likely why this path makes sense, and likely what will happen and what will play out. Again, that's going to be a slow-moving train. You can't just go off the dollar tomorrow. There's so much long-term debt that still needs to get paid out in dollars, but over time, you'll start to see these trade block agreements that are not situated around the dollar. I'm sure some other kind of liquidity backstops will start to get created, and when that does, that will likely be what the top of this cycle is, and then you'll start to see the dollar really devalue quite swiftly. But again, that's quite down the line from here. All right, there's kind of everything I wanted to say, I think, about the Eurodollar system, how it applies and how it ties into the long dollar situation. Again, I just like the pattern we're seeing play out here, and I think it makes sense to me that very soon we'll start to see a rollover. And again, even if we don't, this is a hedge to me. This still is a hedge until it just becomes a straight up play here. But this is just kind of the first step. So there you go. There you have it. and let me know if you need anything fleshed out there in terms of everything I was going over. And yeah, I can follow up if you have any questions on that stuff. All right, let's move on to just kind of some U.S. data here real quick to finish things off. This will be pretty quick. Let's see. I think I actually wanted to look at, here we go. Yeah, U.S. banking, our banking data are non-mortgage-backed securities, non-MBS, and all mortgage or in all commercial banks, so other securities, effectively equities. Where we continue to push up, we're almost into expansion territory in terms of rate of change year over year. So this is looking very strong and just kind of continues to confirm kind of the long equity call. So happy to see this. I just thought I'd throw that out there. The fiscal side of things, we continue to hold on. We will have some issues if coming into September, if we can't get the debt ceiling figured out. But as it stands, the situation for equity still looks good. We might be a little overbought. Again, I'll talk about this during the Elliott Wave update later this weekend, but we might be a little overbought. We definitely might be looking for a pullback at any time, but as it stands, the kind of those underlying fundamentals are still pretty strong, so no worries there. In terms of the broader economy, we are starting to see maybe a little bit of a weakness. We did see some nice retail sales, so that's nice, but that can be short-lived, and there's obviously a lot of variability within retail sales. So, but that was, I mean, all in all, that was good. However, on the PMI side of things, manufacturing PMI, a little bit of underwhelming print this month. And yeah, not the strongest growth. We still remain above that 50, meaning we're expanding. However, yeah, not the strongest growth. And if we look at kind of the best leading indicator to PMI, lumber, yeah, we continue to see some lagging results here. And yeah, again, based on kind of our two core numbers, the banking data and the fiscal data, I still think there's good reason to be long equities here. In terms of kind of the rollover in the economy, yeah, we're starting to see some just lackadaisical prints here, if you will. Nothing terrible, not as bad as Europe, but it's yeah, we're definitely not seeing any real signs of reflation, I guess I should say. And until that shows up, we need to be careful. And that's kind of why, just to kind of wrap this all together for this evening, that's kind of why I want to start those initial hedges, because I could be wrong. Maybe we could be more on the 6-month side of thing as opposed to the 9-month or 12-month side of thing for where we're at in the cycle. But yeah, I wish it was better, but it's not. We kind of have to go with what we have. And yeah, we're just seeing, I mean, we're seeing what we'd expect in a wave 5 of a cycle. We're seeing data deteriorate while banks go crazy, and that's just kind of, yeah, that's just kind of what happens. So we'll keep an eye on this. Obviously, every few weeks we check in when the data comes out. But as it stands, yeah, I'm going to expect just maybe not the booming stuff that we saw in 2017 through 2018, and instead maybe in the latter half of 2018 might be setting the stage. So anyway, that will wrap things up for this update. And yeah, if you have any questions, as always, send them my way, and I'll either answer them in a video or there. Let's see. And if you need anything fleshed out, if something didn't make sense, or feel free to ask that as well. So yeah, hopefully this was helpful and instructional. And yeah, we'll see you for that Elliott Wave update later this weekend. And until then, good trading. Yeah, we'll see you then. Bye bye.